Tell us a little bit about the environment with which you are currently writing checks. Is it active for you? Seed seems to be an area that's been really resilient.
Absolutely. So thank you so much for having me. So the seed stage market is definitely more resilient, especially compared to the later stage market, but all of it really trickles down. And so while I think this is a great time for new founders and new ideas to be built, we still do have to look at what's happening at the IPO market, the later stage market, and even at like the Series B and Series A markets to understand what's happening at the seed market. It's getting harder for a lot of founders that raised in 2020, 2021 to raise their follow-on rounds. And so because of that, VCs are having to spend more time with their portfolio companies and really just kind of re-understand what's really happening with the market right now and understand what valuations that we need to be focused on, what metrics that companies need to hit, because all of that's gone through recalibration at this point. And so that's really important. And so that really has had a trickle down effect in terms of what's happening at the seed stage. So overall, it's definitely more resilient to what's been happening, but it's still, we're seeing a slowdown across the entire market.
Well, the one area of resilience, of course, has been anything that's had artificial intelligence in its name. What portfolio companies are leveraging that innately, and what companies are able to pivot to start to make the most of this sea change in technology?
Absolutely. I think that it's become definitely a buzzword and something that helps you raise a ton of capital at this point. And it's something that we are really excited about. Just we think that it's a technology that across all sectors is something that, whether it's existing portfolio companies or new companies that we're looking at, should be thinking about, because it can really just expedite the use of data and technology in ways that we really haven't thought about before. And so we're really excited about it. And we have two of our portfolio companies are really innovating in the space. So one actually that's been around it's a Series C company called Vic.ai. They are an accounting company that applies and integrates AI into the accounting process for enterprise software companies. And so what we are most excited about this is especially using private data, and this is something in fintech, why areas that are more regulated like fintech and healthcare will be a little bit slower in our minds to adopt AI. It's because you're using a lot of private data, and the ability to trade some of these language learning models will just take a little bit longer. And so with Vic.ai, they've been able to do this over the past few years. And so they're able to continue innovating a lot faster and being able to apply new use cases and new AI models on top of this data that they've already had to continue to improve and make their AI software and their platform even more efficient for their customers. So we're really excited about them. And then another one that's actually not in the fintech space is called CoRise. They're in the learning development space, and they provide expert-led courses to learners to help them develop their skills and level up. And the founder came from Coursera, and what they're doing is really using applying AI to their existing platform to help them scale learners even more so, and apply personalization and support in real time. And so that's a great use case of something that wasn't necessarily applying AI and making it even faster and better. So we're really excited about that.
Jillian, here on Bloomberg Technology, and in particular Venture Spotlight over recent weeks, we've been talking a lot about the idea of cerebral valley, that the kind of energy in AI is here in San Francisco. You're joining us from New York. Where do you see the talent and the opportunity geographically in terms of the portfolio companies you have and those you're looking to invest in?
Absolutely. So Cowboy Ventures, we are split between Palo Alto and New York. So we do have coverage across the US, and for the most part, we focus on the US when we invest. In terms of where our portfolio is split, I want to say it's around 60-70% West Coast and 30-40% East Coast. But that has definitely continued to evolve. I mean, I think obviously COVID was a huge driver of that, but we continue to see our founders kind of, first of all, move around even after we invest, sort of they decide where they want to live, but also in terms of the talent that they are hiring. And this drive for obviously wanting to cultivate and build an incredible culture of their team, but also wanting to make sure that they're able to get the best talent that they can. And so we see a lot of them, maybe in the early days, wanting to all be together, but at the same time, making sure that they can hire the best people no matter where they are. So oftentimes it's split between New York and the Bay Area. And so we'll do a lot of offsites together and making sure they're getting together at a pretty regular cadence. And so especially for me within the fintech space, a significant portion of the companies that I've invested into are on the East Coast. However, we're extremely flexible. We're kind of flying back and forth, and we really take a team approach in terms of our coverage on both coasts.
Valuations, how do they look to your mind?
Absolutely. I think there's, as I mentioned earlier on, there's definitely been a recalibration. And I think we'll see, unfortunately, a lot of companies that raised over the past few years have to level set are for that next round. We've seen it with some new companies and even had to have some conversations with some portfolio companies that you can hit the metrics that you were told you needed to hit for that next round. And the problem is that the bar has raised. Yeah. And so your expectation of getting that dream valuation might not be real anymore,
and Jillian,
especially for the metrics that you're
point. How are they incentivizing their talent? How are they making the most of more talent coming to the market who've been laid off by some of the big tech companies?
Absolutely. And so I think there's sort of two different ways, and that's something that is kind of continuing to be talked about in terms of how you can incentivize the incredible talent that is now out there, because actually it's gotten so much easier to bring in talent now. A year and a half ago, trying to find great talent would have was taking months, and you actually had to make decisions so much faster. That was problematic because people were making the wrong decisions. I think that's honestly part of the reason why you're seeing these layoffs grow, and especially with some of the companies. Obviously, there's sort of runway issues, but also they hire too quickly, and so you can't hire the best talent all the time if you're hiring that quickly. And so being able to kind of take your time in terms of hiring is actually a huge benefit. But then also I've seen some companies where they're actually having conversations, especially with their senior exec team or with the talent that is their key talent that they want to keep, especially if, let's say, they had to take a down round, and talk about how they can help make them whole or help re-incentivize them or reissue some options at the new valuation because of the fact that their stocks may be underwater at this point. And so definitely is more of an art to it, but people are really thinking about how to protect their employees.